If there is any person who missed out, then I can send them a recording one.
Okay.
Yeah.
Yeah, I'm gonna start. So today's purpose of having this webinar is to go over what we have done so far. It's been almost a year we acquired this deal, right? We're gonna have an anniversary coming up in a couple of weeks, and moving forward, what will be our business plan moving forward, and opportunity that we could present for you guys. Just moving on, just to refresh your memory. You acquired the Edison. It's 1978 and 79 built and 272 units. A lot of them, like 200 units are one bedroom, and another 70 or 80 units are two bedrooms. So it's a pretty good unit mix. For the demographics, we are mainly cater to the the single young professionals, because there's a lot of business centers around this neighborhood. This is kind of like a heart and center of the West Houston markets. Then, of course, it checks all the boxes, right? It's a brick walls and individual meters, individual HVACs, water sewer is just sub-meters, and then we route back to tenants. So all these boxes are checked as an investment prospective. And then floor plans. And here's the kind of updates for what we have done so far. As you remember, our pro forma rents that we wanted to meet for one bedroom and two bedroom for the Edison after renovation was $1,020 for the one bedroom and the $1,450 for the two bedroom. And when we took over, they were getting average of $850 for the one bedroom and almost $1,200 for the two bedroom. And moving forward, 11 months later, for the one bedroom, $850 jump up to almost $1,100. So that's 28% increase we have done so far. For the one bedroom, it's actually higher than our original pro forma of $1,020. So it's like $80, almost $80 higher than what we are projected to get, and almost increasing $250 from the average rent since we took over only short period of time, over 11 months. And for the two bedrooms, we are pushing the two bedrooms to, our focus was actually mainly one bedroom, because 200 units of 270 units are one bedroom. So one bedroom is so important to be very successful as a project, right? If one bedroom gets pro forma rents or higher, units gonna, as a project as a whole, it's gonna be successful. So we have a lack of attention in the two bedroom a little bit, but we push another $70 for the two bedroom and the 6% increase. But if you look at the comps, these comps are very recent. We did the comps last week, and the Ashford Cove, they're all they're doing good job. One bedroom is $1,150, and two bedroom, they're getting like $1,340. And if you look at the dollar per square feet, do you see my cursor? My mouse cursor? Do you see that?
Yeah.
So they're getting $1.36 for the two bedroom. We are still shy of $1.16. So our new pro forma, this is the new pro forma, now is to get the $1,140 for one bedroom, $1.64, and $1,450 for two bedroom. And this is actually original pro forma for two bedroom. So we're gonna hit pro forma for the two bedroom, and we're gonna be well beyond the original pro forma. It's gonna be like $120 higher than our original pro forma. And the comps are supporting $1.67. I mean, $1.1140 for 683 units. They're getting a little bit bigger units for almost same rents already. Markets is well supported for the new comps. So we are very excited about it. And for the operation overall, we have a very strong manager in the Edison. Her name is Karen, and she's doing very. She has been very well, and expense side is very stable. We don't see any surprises. The expense month over month is like very stable and steady. So I think we are, the units is well under control. And for the income side, as you see this rent comps, we rent comps and the pro forma rents we're getting, or the actual rents we are getting over pro forma, income is on the rise. So when we look at the value add deals, we kind of see like a 3 phases, right? First phase is you have to have a good cost base, good deal. You have to find the good deals and acquire those. And the second phase is the renovation, right? You have to reposition the deal from C to B or whatever the case may be. Renovation is a very important part of the value add, and most of the heavy lifting part is already done, so that risk is already behind us. So now we are getting to the third phase, that's the fruitation, right? So now we are pushing the rents, continue to push the rents, because we can only renovate units maybe 5 to 10 units a month, because as we have the vacant unit available, that's when we're gonna renovate the interior. So it's going to take time, right? The renovation takes time. The interior renovation takes time, like 18, 24 months. Now we are getting into the, kind of focusing into the interior renovation to increase the revenue. So we are getting the third phase, which is the fun part of it, to see financially. So we are very excited and very thankful that the deal is going to the right directions and very well positioned for. We are already in well positioned to increase the revenue. So as you can probably remember, that was the property conditions when we acquired, the building colors and amenities we have, which is not bad, which was okay. The previous owner was do a good job just keeping up, but we see this is lack of like attentions and the color schemes or designs is a little bit outdated. So we have to refresh everything, make sure that we present a deal as like you walk into the Class A deals. Like that's our kind of goal, to make it so that they can, have the good image of the property when they come to see us, and think considering leasing the property, you have to have a presentable curb appeal, presentable leasing office, and the presentable amenities like pool and fitness centers, and of course, you have to have a spotless, clean model to close the deal, right? For the prospect tenants. So we have done most of it, and you see that pictures. So this is the previous, when we took over. So these are the look and feel that we had previously. And then, as you remember, this is the previous owner's classic units at the bottom, and renovated units up on the top, right? So they did, good job, but still, today's trend and today's markets, it's a little bit outdated, our opinion. So we have gone a little bit farther and they did a little bit better renovations. So Eleonora, you can take it from here.
Yeah. So the improvement that we were planning for stainless steel appliance and hard surface and cabinet, all the tile backsplash, and so far we did in a very cost-effective way. Also the amenity enhancement. I can show you from the next slide, please.
Another slide.
Yeah, the original plan is we were changing the facade of the office, and then also the outside exterior painting. So we removed the ugly color, which is harsh, and the cost effectively we just cover the color is going to be more modern and presentable. So all the facade And then the building sign, we already order, we're waiting for permit to install. It will be look just like the Edison, that nice new logo. And if I show you from what we already have done for the next slides. So improvement is already done. We have changed the exterior color and also waiting for the new signage, which is a very nice, modern, fancy looking of the oil rub black metal will be in the top of that triangle. And then the right picture is the building exterior. We go with a very neutral gray color as we planned. So we already have done those improvements. If we go with the office picture next. So right now we have going to the color theme is a blue, and the website in that logo is going to be royal blue. So cost effectively, we just replace the ugly furniture, which looks like very outdated. And we remain the sign, but just change the statement wall in the reception counter, and reception counter replaced with a more practical use for the staff to interview the tenant or meeting the vendors. So we just putting the table and look more like friendly and more cozy looking office. So if we go over the next slides. So the improvement is on the motor unit also. It looks like a 90s, very updated looking. It doesn't look like 80s apartment. So what we do is the gray neutral color with a light grayish blue, so that it will more updating and uplifting. And when the tenant wants to look around the unit, it will look a lot more desirable than before. If we go into the interior next, please. So we're also updating some furniture and then the painting to update it. So this is what we have done so far. And if I go over the CapEx plan and the numbers for what we have done. Next, please. Also, this is the, okay, so CapEx and reserve original budget was 2.1 million. And so far we have spent the 450K, and the invest as of the January. So we have the full area, some of the resurface, and also the office area, and then a lot of a landscape because it's a Texas, so there is weather. So we took care of a lot of them in a very, very inexpensive way. And not only that, we interior renovation budget was 8,000, which is 1.6 million, but we only spent about 3,000. So we just remain the surface. If we go back to before the slide, Yoshi, we just keep the counter space before. Yeah, that one. The next one. So we just changed, original plan was a cabinet, but we just remained the cabinet and then painted over it. And we kept the countertop, unless the countertop is a distress. But whether right now their countertop is a condition is good and looking good, still presenting as updated looking, we kept them as a cost effectively. But this is the golden upgrade. But platinum upgrade with the granite or the quartz surface would be 4,000, 5,000. So next, please.
So I can kind of recap this slide again. Like she mentioned, we have spent 450,000. Like she said, our plan is to upgrade interior as a premium upgrade, and the budget was $8,000 per door. Now we were able to upgrade with 3,000 to 4,000 a door. We call it gold upgrade. It's like one step below premium upgrade. But as you saw and I mentioned, we were able to get $80 more rent with the gold upgrade. Our plan is to get, as you remember, $1,020, $1,020 for the one bedroom rent. with the $8,000 renovations, now we are getting $1,100 rents with $3,000 to $4,000 renovations. So we are in a very good position. We probably spend like a lot less than original budget of 2.1 million. As of now, probably we're gonna spend maybe 1.3, 1.4 million, and saving like $800 or $700,000, which will be going back to the investors. So that's additional returns that investor could expect, right, from saving the capex budget and the spending. So excuse me. So overall, capex budget, capex spending is under budget and on time, and we are getting higher than pro forma rent. So we are expecting more revenue moving forward, and the expense side is very stable as planned. So we didn't spend any, and we didn't have any surprises. We didn't have to spend more than what we think it's gonna be for the expense side. So the property is set to grow. This point, like I said, it's in the third phase, in a good property is in good condition, physically and operationally. So that's kind of like a quick update of what we have done last 11 months. I don't know if you want to open up for the question at this point, or you want to say something, Nora, before moving to the opportunities.
So our business plan, the executing in the moving forward, we wanted to some preparation for the rainy days. So if you interesting for the more number or any other additional investment opportunity, or you can stay here, or you can you can stay until the end, and then we can have a Q&A until the end. But for now, if you have any question, this is a mid checking time. Please put your question on the Q&A session. There is a chat, but otherwise we were just moving on to the business plan. Okay. So far so good? Yeah, I think we can just move on to business plan.
Okay. Yeah, like I said, we are in the third phase, right? Acquire distressed property at the good cost basis. We have done it, and improvements and renovations, we have done it. Almost done it. At least all the heavy lifting part of it's done. So all the risk is like behind us. Mitigate all these risks that involved for the value add deals are behind us. Now it's stabilized through the strong operations, and like I mentioned, it's strong operations already. We are just in the fruition stage, just to continue to increase the rents and increase the revenue, and bring up to where we want to be. And exit strategy now, I am thinking is probably two years. So that's yeah. Hopefully we can get out in 2 years, 2 to 3 years. And when we say get out, you know, it could be a sell or it could be refi, cash out refi. And partners, and here's the extended offer. So as you know, and we announced it in the last monthly reports, that we actually extended the original offer from 10 million to $12 million. So reason is that when we purchased, this is a floating rates, right? So we have to purchase the rate cap, and when we purchased the rate cap, original quote was $150,000. When we signed the PSA contract, but by the time we closed, that's 2 months later, they came back to us and say, hey, it's going to cost you $290,000. So jumps up almost a double. So that's the market was kind of like shifting back then. Like, as you remember, back last year, March, that's when like interest hike just started, and the market kind of get panicked, and the rate cap price went up, you know, start to go up. So we paid $290,000. That's a little bit over budget, right? But now same rate cap cost us if we buy the same cap today, it's going to cost us $1 million. That's the latest quote. And our rate cap will expire next year in March, because we bought 2% strike 2-year rate cap, and that's going to expire next year. So we have to buy a cap again next year. And if the market continue to be this way, it's going to cost us $1 million. So we have to be ready for the worst case. We need the $1 million to purchase next rate cap. Luckily, we still have the debt is like 3 years and 2 years extensions. So we still have a 4-year of debt. So debt not going to mature another 4 years. We have enough time. It's just the only thing that we have to prepare is to purchase the rate cap next year. So instead of waiting till the last minute and then try to figure out what we're going to do, we want to prepare for the worst. So we want to extend the offer to 12 millions to have enough reserve in case the rate cap price doesn't drop and then still cost us $1 million next year. That's the main reason we're going to extend the offer to 12 million. Nothing else. The operation wise, it's strong, and the property itself is still doing great. And again, the location is great. So property is going to be strong by the time the market shifts again. Market shifts back to the growth period, right? So right now, Fed is still signaling that they're going to continue to raise interest rates, 1 or 2 more, and hopefully they're going to stop raising the rates maybe middle of this year, June, July. That's what we are still seeing, and keep it there for a while, and eventually the interest rate is going to come down, right? So the market cycles, and the interest rate not going to stay high forever. It's going to go down at some point when the economy cools down, right? So when the interest rate stabilize, meaning they don't have to come down, it just have to be stabilized, meaning no more hikes, then rate cap price it start to go down, because now they have a prediction, so they can price it without anything like so right now they're quoting with the buffer, right? Because it's still unpredictable a little bit, so they have to charge more to cover themselves. Once it's stabilized, it's more predictable, so that they can price it a little bit lower. So price will start to come down, and when rates is coming down, then price is going down further. So it's going to go down a lot less. So hopefully, when we purchase the rate cap next year, we still have like 13 months. It could cost us maybe $500,000 or $400,000 or $700,000. Who knows, right? The market is something that we can't control. Somebody could, but we can't. So worst case scenario, it's going to cost us $1 million. So that's why we wanna raise money now. And if it comes down, and if we pay only $500,000, whatever, then another $500,000 that we're going to save going back to the investors. So that's going to add to your returns. So new pro forma we have with the new pro forma rents and new underwriting we have as of end of January or last month, we are looking at the pretty much similar returns, 16 to 18% average annual returns, and the 50 to 16% IRR. And this underwrite is based on 2 more year hold, actually. And just to the comparison purpose, if you take the average annual return and the times 5, that will give you the 5-year return image of 82 to 90%. That's just for comparison only. But so the return looks same, because this underwrites is actually based on the interest, the maximum interest rate we are paying, which is the 6%. We are paying 6% now, but the pro forma rents is going up. So actually, we are able to kind of keep the same type of returns projections as of today, so which is a good news. So six there, as you can see, 6.06 with the rate cap is the maximum interest rate we're gonna pay. We are paying right now, and the underwrites, new underwrites, and the new returns you've seen previous slide is based on this 6% rate cap, and the reversion cap is still the same of 5%. And the sources and uses they stay the same. It's just the only difference is the maximum equity offering is now 12 million, and so operating capital goes up to 3.4, and again that's the reserve for the rainy days. So this is a new underwrites. You know, we are now plan to get out in the next 2 years before 3-year loan maturity comes. And like you see, like the return is pretty identical from the original offering. And then this is a stress test as of today's underwrite. Still, like we are getting 57% annual total returns in 2 years, which would be like 16 to 18% average annual returns to the investors. And the worst case scenario, if we don't have 3% rent growth, but just 1%, and reversion cap is not 5% cap rates, but 5.75, we are still making the returns, 34% returns. But the upside is pretty good. If you look at it, if the market turn around and rent growth is like instead of 3%, 3.7%, which could be very possible. And then reversion cap, when the interest rate start coming down, the cap rate is coming down again, right? And if we can get out in four and a quarter cap rate, the return jumps up to 120%. So we still have a pretty good upside opportunity. Depends on how market's going to react, or it's really like how the interest rate goes, right? It's really we are the challenge facing today is the interest rate. Everything else is good, so we just watch closely and act proactively. Depends on how the interest rate goes. But the stress test shows that we are still in a strong position as a deal. And deal structure is the same thing. We give 10% pref or 7% pref, depends on the class, and after that it's 30-70 split, and everything is stay the same. So extended offer summary. So if you decided to invest additional investments, or if you are new and you want to come in for this deal, be able to invest now. So it's going to be a shorter investment period. We try to get out in 2 years, and the major value add renovation is already done. So the one of the big risk for the value add is already behind us. And again, it's a B plus asset in the prestigious Westheimer Street, which would be kind of like a Preston Road in Dallas. So if you are in Dallas or the DFW area, it's easier to imagine like if you have a deal in like North Dallas or South Plano on the Preston Road. This is the location like that in Houston. So you can't replace the location, and we have that. So that's good. So that's kind of like a business plan and an extended offer that we have. Those of you who doesn't know much about the Houston markets, Eleonora can quickly go over the market again.
Thank you, Yoshi. So the Houston market is still the strongest in the top number one, the population growth in the country. And if we can see from the 2020 through the presumption of 2025, it will be 7% increase, which is 510K, the population growth. And if we see in a job focus wise, employment growth from the Houston area is the top number 2 of the whole nations. So they have a 473K job has been increased, and employment, the growth has been 15% yearly. So if I'm moving on to next slide. So we will cover, next please, Yosh. So if we were covering for that employment and population, this is more likely submarket of the centralized prime location in West Houston. So all the employers in that centralized area surround the Edison. So Westheimer is the old rich neighborhood. There is a lot of a demographic that living in as a 88K, 90K, the income. And what I favor is right in front of the Edison is the good location benchmark of Starbucks. And also they have house average home in that area. This is outdated. It's just 600K around the area now. Before was a 400K. That was a year ago, but now the price is so much higher. And the average income, average age of the young hip, the single or the age is 35. And as you can see, all walking distance from the 8 miles radius, they have a tons of retail, restaurant, and then grocery. And literally, they can do 5 minutes to everyday employee, like Energy Corridor and Memorial District and West Chase, which is a prime employee of the white collar. And the white collar employee in that area is 70%. It's a predominant. It is a really nice location as Yoshi said, it's a West Plano, like a legacy, and around the Frisco area. So if we're moving on to the more in-depth of the location for next slides. So as you can see, there is a 6 large healthcare center representing as Memorial Hospital, Memorial City, Memorial Hermann. And not only that, there is an A-class retail center. Is a so much close by, which is a 5 minute, literally the 5 minutes away from. Not only that, Uptown and Galleria. As we know, Galleria is a top dollar, the shopping retailer, like a designer's brand. So all this combined employ and nice employment and entertainment and all the shopping, it will pamper the good demographic to bring us to the higher paying tenants. So we are continuously reaching that goal, and we are getting really close to each every month. We replacing the tenant and with a good improvement. So if we're moving on to next slide. So again, the Memorial District, and so it's a repeating, but it's a very important that we know that it's a Memorial District, and energy corridor continues giving us the quality tenants, and a lot of our population still keep coming to Houston. So please rest assured, we have a pretty confident on this deal, and we just wanted to prepare the market since we don't have a crystal ball, but we don't want to blame the market. We proactively preventions what we can do the best out of this deal. So Yoshi, do you want to take over to wrap it up, the business plan?
Yeah. So yeah, business plan. Yeah. Yeah. We already said it, the operationally deal is going well, and we just wanted to prepare for the worst, make sure that we get through the storm of this interest hike. And unfortunately, real estate is directly affected by the interest hike. Regular business, there's a time lag. When the interest goes up, maybe 12 months later, 24 months later, they'll start to feel it. But the real estate, we're gonna feel it right away. So it's kind of like good and bad. But once it's bounced back, we'll start seeing really quickly again. So that's the upside too, right? Once the interest rates start to comes down, we'll start to seeing the investment activity is getting heat up again, and the price is going up again. And once a lot of the equities, including institutional investors, they are waiting on the sideline right now, and they're waiting, almost ready to go right now, because once the interest rate stabilize, meaning stop hiking, doesn't have to come down, stop hiking, investor can have a prediction as well. So if the number works out with the interest, with the cap rate, whatever they could do or we could do, because we can still buy a cap, like in the money cap, to keep the interest low and get into the deal. And then if the number makes sense, the investment activity start to heat up again. And once that there's a sign of the interest going down, that's when all these capital that waiting on the sideline flow into the real estate markets again, because it's one of the best asset class in the investment sectors. Overall, all the investments, right? Stock, bonds, other commercial real estate like retails and offices, you know, hospitalities. The multifamily is one of the strongest and one of the most what do we call it, the less risk type of investments. Once those big well investors comes back into the markets, the price will adjust really quickly. So that's actually the good side of the real estate, because they're gonna feel the change very quickly. So that's why I said 2-year exit, because that's going to happen very short period of time. Now is a good time to invest, so that 2 year from now, 2 years from now, when you see the interest rate is stabilized or coming down, the price is already up there. You can't have the good deal anymore. I think it's a good time to invest for deals that operationally strong and have a good strong underwrites. That's what I think, and that's what I believe. So again, investment opportunities, it's same thing. Class A members, minimum investment is 150,000, and we're gonna give 10% preferred returns. So the 10% returns goes to the Class A members before anybody else. And after that, it's 70-30 split. So we are predicting what we're expecting 15 to 16% IRR, 17 to 18% average annual return for the Class A investors. And the Class B investors is right behind the Class A investors. It's 50,000 minimum, and we still give 7% pref on preferred returns to the Class B members. And the IRR and average annual returns is a little bit shy from Class B, but it's kind of similar, just maybe 50 basis point less than Class A members. That's our underwrite suggested. This is the returns that we are expecting, and a 70-30 split after 7% pref. So this is just a comparison only, but if we can get out in a 5% rate cap, not the rate cap. Rate cap is a hot topic. I used to say rate cap a lot, but the 5% cap rate exit, then you get 17% IRR. I'm sorry, 17% AAR is average annual returns, or 16% IRR. But if we were able to get out at 4.5%, which could be very possible once the interest rate have a sign to come down, the market's gonna quickly react. Then that's gonna jump up to 140%. 28% average annual returns and 25% IRR. So we still have a great opportunity, but don't invest based on the best case scenario, right? Just please make our investment decisions based on the moderate risk numbers, which would be the 5% cap rate and 17% average annual returns. So kind of recap of Class A and Class B. So risk is a little bit higher on the Class B, and Class A is the risk is a little bit less, because we have to pay senior debt first, right? Senior loan first, and if we make the profit, that goes to the Class A member first, and we satisfy the 10% preferred returns, and then goes to Class B members, and we satisfy 7% preferred returns. And after that, finally, GP team like Eleonora and I will get compensations after we satisfy 10% and 7%, and that's 70-30 split. So we don't hit that preferred return threshold, we're gonna work for free. So that's how we structure. We put the investors first. So that's it. We have a subscription link that Eleonora has it, so we can, and it's open now, so you can invest now. Hey, Eleonora, you're on the mute.
Yeah, so I can email you about the information, the recording.